Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for the week of October 26th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge. I'm pleased to be joined here once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. And as now we are just a few days away from the election this coming Tuesday, November 3rd, Steve and I will take one last look at the pre-election landscape, and in particular, what the election could mean for the U.S. Treasury market and interest rates. But before we get to the election, brief update on the markets this week. It was an up and down week, but basically down at the end of it all. Wednesday was a tough week for equities, worst decline since September. Then on Thursday, the market bounced back with good corporate earnings news. And then on Friday, corporate earnings news from the big tech companies was okay, but their forward guidance gave investors concern. So that was a tough day. So up and down for the week, but at the end of the week was negative for the equity markets. So Steve, election now, it's just a few days away. Let's take a look at some of the different pre-election scenarios, what they could mean for the market, and in particular, what could it mean, the election, what could things mean here for the fixed income market? Because most of the time when people talk about the election, they want to talk about the equity markets. But it could well be that the upcoming election could also have an impact on fixed income. And there's this consensus view out there that if we have a blue wave and the Democrats are to take the White House, the Senate, and the House of Representatives, investors are expecting the U.S. Treasury market, the interest rates there, to go up fairly quickly. You could see the U.S. 10-year go right through 1%. And then conversely, you have a consensus among investors that if it's a status quo election and you still have some form of divided government, well, then interest rates could decline from where they are now, down to maybe 60 basis points. And then if it's a contested election and it gets drawn out, then markets are saying, well, gee, you could see the 10-year go below 60 down to about the 50 level. So keeping in mind that one, consensus is usually not correct. And two, it's oftentimes binary, right? So they're predicting either this or either that. And usually what we get is something more nuanced. So with that long-winded intro, how do you see the upcoming election affecting interest rates and in particular the U.S. Treasury market?
Well, I would agree with you, Fritz, that if Congress remains divided post-election, there is less chance of a major rescue package happening anytime soon. And if that's coupled with the coronavirus continuing to be worse than what was originally expected, the economy could take another hit. We could see this recovery stall out and maybe even worst case, a double-dip recession. So if we look at this market cycle chart that we have for you, you can see that if the economy slows down, then we move to the bottom of that chart and bonds will do well, which is the same thing as saying bond yields would be going down, anticipating the economic slowdown. So that could happen. And I agree also with what you said. If there's a blue sweep, meaning that the Democrats win all three phases of the government, then people expect reflation. People expect more spending, more demand for money, bond yields going up. But the nuance is in the lame duck session, even if we had a blue sweep, there's a good chance that either the Republican lame duck Senate or the administration would decide that they have no incentive to cooperate with the new administration and the new Senate coming in. And we could end up being delayed until sometime after January 21, and it could take until February or March. And the stimulus that we had back in last March, April timeframe won't last that long if things really go down. So we might not get the rise in yields that people expect.
Very good. So that covers the upcoming election and the impact on the treasuries. And now let's actually, I think it's a good idea, let's take a step back and think about the bigger picture, if you will, the longer term, beyond just the election. And as we know, historically, investors have counted on holding bonds as a hedge against their equity holdings and for the purpose of generating income. And this would include the traditional 60-40 portfolio approach, which has been a mainstay for investors for many years. However, where we are now with interest rates at such historically low yields, it certainly seems as though investors are going to have to rethink this more traditional role of holding bonds in their portfolio. Maybe you could touch on that, because I think that's important as we go through the election and beyond.
Well, that's right, Fritz. Since the early 1980s, when interest rates at that time were very high, they were at all-time peaks. Then following that period, bonds have done very well over the last 40 years. So people have been conditioned that bonds, and even over and above inflation, bonds have done well, even in periods when stocks have not done so well. However, you can see on this next chart we have that the opposite happened from 1940 to 1980. In that period, bonds didn't even keep up with inflation. In fact, if you were a bond investor in 1940, you would have lost substantial amount of wealth compared to inflation over the next 40 years. Fortunately, the conditions today are very similar to where they were in the 1940s, meaning that interest rates are very, very low. So it's possible that bond investors will have a very hard time repeating the success they had over the last 40 years.
Very good. So one thing I think is helpful, since we're talking about interest rates and bonds, is to do a quick Bond 101 and just to explain the difference between bond prices and interest rates, because it can be counterintuitive and sort of confusing, since, as we know, bond prices are going up, yields are actually going down. So can you just maybe clarify that?
Yes. So to keep it very simple, when interest rates go up, bond prices go down. Why is that? It's because when you buy a bond, you're lending money over some period of time, and you're getting a fixed set of payments for lending that money. And if interest rates go up in the future, then people are less willing to pay what you paid for that same income stream, because that income stream is fixed. They need to pay less so that they get a higher yield or higher interest rate from that. Similarly, if interest rates go down, then people are willing to pay more for that income stream that you locked into when you bought your bond. So the bond price or the value of your bond goes up. So it's opposite. So if interest rates go up, bond prices go down. If interest rates go down, bond prices go up.
Okay, I'm going to tell you a story. The first time ever someone explained that to me, they said, hold your arms out to your side, and if interest rates go up, bond prices go down. If bond prices go up, interest rates go down. I won't admit to still using that, but that was the first lesson I ever got on that equation.
And
so
you still remember it.
I still do, yeah. So here we are. Election is 4 days away, and we have investors and clients alike are nervous about what this could mean for the markets. You could potentially, we probably won't have a winner of the U.S. presidential election on the night of the 3rd, but maybe early morning on the 4th. But then there could be some swing states where it takes longer. So I just thought it was important to reassure our clients that our investment committee will be meeting regularly over the course of the coming days. We'll be rerunning our models, watching the markets, watching investor behavior, and remaining vigilant and poised to take action should that be necessary, which it may not be. But I also want to highlight one thing about our strategy, and something that I really learned from you and your approach, and I think it's really important. And this is the idea of making sure that you have in your portfolio what I would call a margin of safety. And what you find is that oftentimes when investments fail, it's not because the investor was completely wrong, but rather they were putting themselves in a position where they had to be exactly right, and they didn't have a margin of safety built into their portfolio. And one of the foundational beliefs of our firm, again, I learned this from you, is that what is essential is maintaining these broadly diversified portfolios, diversified at all times across asset classes and geographies, so that you have in your portfolio a margin of safety, and so that your portfolio can get you through any number of a broad range of outcomes. So that will do it, actually, for us. Steve, thank you very much for your insightful comments. Appreciate your help as we go into the final days before the election.
Thank you, Fritz.
And Steve and I will be back, as we always are, next week with another Week in Review video. And next week, we'll actually be able to analyze the election results and talk about what those could mean for the markets going forward. So on behalf of everyone at 3 Edge Asset Management, we urge everyone to remain safe and healthy. Don't forget to turn your clocks back. Don't forget to vote. And thanks for listening.